G'day everyone, welcome to another 360 Partners video. Today, Jason O'Shaughnessy. Jace, how are you?
Good, mate. How are you?
Well, thank you. Today we're going to be talking about finance and loans and interest rates and some of the things you've got to look out for. So what are we talking about today, Jace?
Well, the main thing we're going to talk about is why when you get a new mortgage with a great rate, is it a great rate for about 3 months, then all of a sudden you don't have a great rate.
The honeymoon's over.
Yeah.
All right, so tell us about it. So your average mum and dad, they go and get a home loan, they think they're getting a pretty good rate. They might go along in the current market and get somewhere in the sort of high twos or what have you. Then what happens?
Yeah, so the banks have a way to reprice your mortgage continually, whether rates are going up or they're going down. So let's just talk to some even numbered rates. So let's say you got a new mortgage 6 months ago, and the rate was 3%. It was best in market, and you're happy with it. Your friend Alex then gets a mortgage 6 months later, and all of a sudden his interest rate is 2.5%. Now, there's been no announcement of RBA cuts or anything like that. So you're sitting there thinking to yourself, well, why am I very quickly out of the market with the rates? What the banks end up doing is they will, at the moment, the cost of funds are going down for the banks, and that's why the fixed year, 3, 4, 2 fixed year rates are so much lower. That's where their cost of funds are going from the market where they borrow. As those funds are going down, the RBA aren't reducing rates because they don't have any more capacity to, essentially.
They're already pretty low.
Yeah, so the new clients, as their cost has gone down, they will deliver that to the new clients. Whereas the existing clients, there's been no trigger point, so they won't reduce the rates, they'll just keep them where they are.
Got it. So we were talking about this before, and it's probably the case that when you're in a declining interest rate market, the trigger and the cost to people is a little bit less visible. I mean, clearly when interest rates are going up, people see the money, and so they're constantly thinking, geez, I need to revisit this. But in a declining market, that's less obvious.
It is, yeah. Once again, you have a great rate. You don't know that the rate should be decreasing because there's no trigger point for you, and there's no external trigger point, meaning that if the rates are going up, you get notified by the bank that your rate's going up. So you might say, hey, is this the right thing? Just like with the RBA. Like the RBA is the external trigger point for you. Rates are going up, rates are going down, should I review? When we're in this current environment where rates are going down, but there's no trigger point for you because there's no cost, and there's no external trigger point because the RBA aren't announcing it, well, there's a big opportunity cost that starts to swell.
And on the average home loan these days, we're talking about like big money.
Yeah. So probably in the last 12 months, the variable rates have moved from, let's just talk percentage-wise, probably 25 to 30 points.
Yeah, and on a $500,000 home loan or whatever or more, there's some serious money.
Yeah.
So, all right, so it's costing people money. What do you suggest? What do people do about this?
Well, the main thing is that you should be reviewing it at least yearly, which is speaking to the bank and making sure that you are on a very, a good rate. You also do need to know what is good in market for that rate. Like there's a multitude of products, and is it principal and interest? Is it interest only? Is it P&I? Is it an investor loan? So it is quite opaque to know what a good rate is. So that's why with my clients I'll have the trigger point for me is not necessarily the RBA announcing it. It's every 12 months or sometimes more.
Yeah, and one other thing, we'll do another video about this at another time. It's important to understand the comparative rate because it's not necessarily just the interest rate that costs. There's often sort of hidden fees as well.
Yeah.
So we might do a separate video on that one. So we've just talked about residential. Obviously, that can be an extra cost to people if they're not monitoring it. Commercial debt's a little bit different.
It is different. It's far more complex, probably a little bit more opaque as well. It effectively works the same way, the way that they internally reprice. The big difference is that there's probably more different margins and fees in there that they can tweak with. So, they extensively based off BBSY, but they then have a liquidity margin in there, they then have a customer margin in there, you'll then have a service fee in there, and you might even have line fees as well. So, that's 5 or 6 different costs to you. Some of them are, written on your loan contract. If they move them. Some of them aren't, like the liquidity margin, which are most of the, sub $5 million business facilities are based off, is literally a margin that the bank will change every day depending on how much they want to charge you.
Yeah, well, I guess commercial debt's much more nuanced, and there's a lot of variables, and they're completely different risks for the bank. So some of that's understandable. But that's fantastic, Jase. So I think the message there is, from what you're saying, people need to be careful that they don't miss out, that they get their rates competitive, that they review them. And I think we'll do a separate video on comparative rates. Hopefully that's been helpful for you today. If you've got any questions, by all means, you can email Jason or post them up on our Facebook page. So until next time, we'll see you then.
See you then.